Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Saturday, April 11th, 2026, and we're here to break down the market buzz from yesterday, April 10th.
That's right. Our AI models were quite busy sifting through a mountain of user discussions and market commentary. We saw a high volume of posts, with a handful of stocks flagged for a deeper dive.
And the overall sentiment, it's a bit of a mixed bag out there. Some truly promising growth narratives, but also a fair share of red flags that we absolutely need to discuss. So let's jump right into it.
First up, let's talk about Global Partners, GLP. This one is consistently coming up as a stay away in our analysis, and it's holding firm to that.
Well, Brooke, while the analysis says stay away, there are some interesting points. They did have 11% revenue growth, and that 6.61% dividend yield is certainly attractive for income-focused investors. Plus, there was some insider buying, which is usually a vote of confidence.
Ethan, that 0.43% net profit margin is just razor thin, and the debt-to-equity ratio at over 300? That's a huge financial risk. User sentiment points to intense competition from superior GLP-1 drugs and cheap generics, which will only pressure those margins further. The news about Eli Lilly and patent expirations confirms it. The KPIs simply don't support taking that kind of risk, dividend or not. So for GLP, our AI-generated insight remains a stay away.
All right, fair enough. Next, let's look at Oracle, ORCL. This one has been flagged numerous times, and there are some really exciting things happening, especially with their push into AI.
Ethan, Oracle is another stay away, and frankly, it's been in this category for a while now. The debt-to-equity ratio is astronomical, over 400. That's a ticking time bomb according to some users. News reports even highlight increased credit risk due to their heavy AI investment.
But they are integrating NVIDIA B300 GPUs, and there are analysts out there suggesting Oracle is among stocks set to explode in the next 3 years. The upcoming June 10th earnings could be a massive catalyst if they deliver on their cloud growth guidance. They have a solid net profit margin of 25% from existing operations.
That high debt, combined with market skepticism and a 30% drop this year, just puts too much pressure on those future earnings. The AI infrastructure growth needs to translate into a massive, undeniable acceleration in overall revenue to justify that leverage. Until we see clear, sustainable debt management, Oracle is a stay away.
Moving on to something a bit more, shall we say, colorful, Trump Media, DJT. It's had quite the ride, and some users are still talking about manipulation that could see it at $200. It's been rising in April, too.
Ethan, that sounds less like an investment thesis and more like pure speculation. The fundamentals are, non-existent. We're looking at negative EPS of minus 2.8, revenue growth near zero, and a net profit margin of literally zero. This company is losing money and not growing its top line. The stock's current price is near its 52-week low.
True, the fundamentals are challenging, but the volatility and social buzz can create opportunities for short-term plays, It's often driven by unique external factors.
Yes, but from a fundamental risk-managed perspective, a stock that relies on manipulation and has such dire KPIs is an absolute stay away.
All right, now for a big one, NVIDIA, NVDA. This one is constantly being chased by investors, and our analysis has upgraded it to a buy today, up from a stay away on April 9th.
It's true. The KPIs for NVIDIA are exceptional. That 73.2% revenue growth and incredible 55.6% net profit margin are hard to argue with. And insider buying is a strong signal of confidence.
Exactly. Wall Street analysts are seeing a 46% upside with some price targets at $360. Jensen Huang's vision for AI factories shows a clear path for continued dominance. Yes, the PE is high, but these are the numbers of a market leader truly transforming the industry.
It is a growth stock, so a high PE is expected, but the debt-to-equity ratio is still high at 7.255. And some reports mention May could be a make-or-break month. It's definitely not without risks. However, given the overwhelming profitability, growth, and insider confidence, the AI-generated insight for NVDA is a buy.
Next up, Palantir, PLTR. User sentiment here is quite strong, even with talk of potential short squeezes.
Strong, yes, but overwhelmingly negative, Ethan. The analysis here is a stay away, consistent with previous ratings. Its PE ratio is an astronomical 203.26. That implies growth rates far beyond its 70% revenue growth, which, while positive, simply doesn't justify such an extreme valuation. But sometimes, a stock's potential isn't fully captured by current numbers. There's enthusiasm, and some users are even suggesting it could hit $200 due to short squeezes. Potential doesn't pay the bills. When insiders are net sellers, as they are here with over 2.7% of shares sold, that's a huge red flag. Coupled with AI competition fears, Palantir is stay away until we see some serious fundamental improvements.
And finally, let's talk about AMD, Advanced Micro Devices. This has been a hot stock, with users securing profits and planning to re-enter, especially with all the AI chip rally news. But our analysis today is a stay away, a downgrade from its buy rating on April 10th.
Ethan, despite the excitement and the 34.1% revenue growth, which is strong, the PE ratio at 93.52 is just too high. It's heavily priced for future growth, but its return on equity is relatively low at just 7%.